Welcome to This Explainer. I'm really glad you're here. Today, we're grabbing our mental whiteboards because we're going to sketch out exactly how commercial banks create money, literally out of thin air. It's kind of like mapping out the hidden architecture of our entire financial system.
It's one of those questions that seems incredibly simple, right? Where does money actually come from? I mean, most of us just picture government printing presses churning out stacks of fresh paper notes or heavy machinery minting these shiny new coins. But is that really all there is to it? What if I told you there's this massive hidden mechanism at play every single day where the money supply is actively expanded without a single new physical bill being printed? No way, right? Well, let's look at how.
Okay, let's dive right into the magic of banking. To really grasp this hidden mechanism, we've got to first understand a commercial bank's true nature.
On the surface, a bank's day-to-day function seems pretty basic. They accept deposits of cash from the public, and then they turn around and use that money to lend to households, firms, maybe the government. But while moving that money around is their day job, their actual superpower, the thing that totally separates them from, say, a mutual fund or a post office savings account, is their absolute ability to actively create and destroy money.
To really see this superpower in action, picture drawing a classic balancing scale in a sketchbook. On the left side, you've got primary deposits. These are completely passive. It's basically just you or me walking into a local branch and sliding physical cash over the counter. This action merely transforms paper currency into digital deposit money. It doesn't change the total volume of money in the economy at all. But on the right side of our scale, balancing the whole thing out, we have derivative deposits. And this is exactly where the magic happens. See, when a bank grants a loan, they don't hand the borrower a physical briefcase stuffed with your cash. Instead, a bank clerk literally just types digits on a laptop, opening a current account for the borrower that they can draw on via check. They actively create a brand new deposit out of nowhere. And just like that, the nation's total money supply actually increases.
So moving on to the money multiplier process. We really need to map out the mechanical breakdown of this credit creation step by step.
Now, before banks can just start typing endless loans into existence, they have to follow a very strict rule called the cash reserve ratio, or CRR. Think of it as a legal mandate that forces a bank to lock up a specific fraction of its total deposits as cold, hard cash reserves. They might keep this locked in their own vaults or send it over to the central bank. And honestly, without it, a bank couldn't possibly meet the daily cash withdrawal demands of its normal customers. But, and here's the real kicker, they are entirely free to take the remaining cash amount, those excess reserves, and lend it straight out.
Let's actually walk through the math here, kind of like we're sketching out a crime scene on our whiteboard. For this scenario, we're assuming a multiple banking system with a legal cash reserve ratio set at exactly 20%. Okay, round one. You deposit 1,000 rupees in cash into Bank of Baroda. They immediately lock up 20%, which is 200 rupees, and lend the excess 800 rupees to a borrower. Round two. That borrower uses their new 800 rupee loan to buy goods from a local trader paying by check. The trader then deposits that exact check into their own account at Canara Bank. So Canara Bank now has a fresh 800 rupee deposit. They lock up 20% of that, which is 160 rupees, and they loan out the excess 640 rupees. Round three. That 640 rupee loan is spent and it gets deposited into ICICI Bank. They reserve 128 rupees and loan out 512. And this cycle just keeps continuing, rippling out through the entire economy.
So the big question is, where does this rippling effect actually end? Well, through this interconnected banking system, as the loans get progressively smaller and smaller, that initial passive 1,000 rupees cash deposit ends up generating a massive 5,000 rupees in total deposits. It's absolutely wild.
And this brilliantly illustrates what economists call the deposit multiplier formula. The multiplier is simply 1 divided by the required reserve ratio. In our little whiteboard sketch, the reserve ratio was 20%, or 0.2. Well, 1 divided by 0.2 is exactly 5. So whatever the initial primary deposit is, the banking system essentially multiplies it by 5.
All right, let's talk about the limits to this magic, because we really need to erase the misconception that this is some sort of infinite money glitch. It's time for a quick reality check. There are actually several strict forces that constrain a bank's power here. Obviously, the total amount of primary cash deposits matters a lot, as does that legal cash reserve ratio we talked about, because if the central bank suddenly raises that ratio, the multiplier shrinks instantly. Business conditions matter a ton too. I mean, during a recession, nobody is really asking for loans, so the whole credit creation engine just stalls out. But look closely at that third factor: banking habits.
If the public suddenly prefers using physical cash instead of checks or digital transfers, the money literally leaks out of the banking system. If you withdraw that 800 rupee loan in paper cash and just stuff it under your mattress, it never reaches Canara Bank. The entire multiplier effect stops dead in its tracks.
Which brings us perfectly to the central bank. It's time to meet the real sheriff of this banking ecosystem. In India, for instance, we're talking about the Reserve Bank of India, or the RBI.
Now, there is a super dramatic contrast between the two. Commercial banks, like the ones we just sketched out, operate entirely on a profit motive. They deal directly with the public, accepting your deposits and handing out loans specifically to make money. The central bank, however, it has absolutely no profit motive. It acts as the apex regulator. It doesn't even accept deposits from the general public. Its sole purpose is to ensure the proper, smooth functioning of the broader economy, and to act entirely for the public welfare.
So the central bank wears a lot of different hats. It holds the absolute monopoly on issuing physical currency notes. It acts as the banker and fiscal agent to the government itself. It acts as the banker to the commercial banks, centralizing all those cash reserves we mentioned. It even manages the country's foreign exchange. But perhaps most crucially, it serves as the lender of last resort. When commercial banks exhaust all their available funds and face a severe financial crisis, they run straight to the central bank for emergency assistance.
Because the central bank sits at the very top of the food chain, it acts as the ultimate supervisor, which leads us to how they actively control the money supply. Let's see exactly how they pull the strings on that money multiplier we learned about.
They do this primarily using what we call quantitative methods. These are tools that affect the overall quantity and the cost of credit in the economy. The absolute most powerful tool in their belt is the repo rate. This is simply the interest rate at which the central bank lends short-term funds to commercial banks, usually against government bonds. So if the economy is overheating with inflation, the central bank just raises the repo rate. This instantly makes borrowing way more expensive for commercial banks, who then naturally pass those higher interest rates right on to you and me. Loans become super expensive, overall borrowing drops, and that massive derivative deposit multiplier actively contracts.
Another brilliant quantitative tool they use is open market operations. If the central bank wants to quickly soak up excess money from the economy, it simply sells government securities directly to the commercial banks. The banks, of course, buy these securities using their cash reserves. With their cash holdings instantly depleted, their actual power to create those derivative loans shrinks, actively tightening the entire money supply.
But, sometimes the central bank needs a precision scalpel instead of a giant sledgehammer. And that's exactly where qualitative or selective methods come in. These are designed to control exactly where the credit flows in the economy. For example, they might alter consumer credit by mandating much higher down payments on car loans just to cool down a booming vehicle market. They might adjust margin requirements on securities to pop speculative stock market bubbles. Or they might just use what's called moral suasion, which is basically calling a closed-door meeting with top bank executives and, informally but firmly, persuading them to restrict lending in certain risky sectors. And hey, if that fails, they can absolutely use direct action and flat-out penalize the erring banks. So, we've sketched out the entire journey today, from a single passive cash deposit rippling through the incredible derivative deposit multiplier, all the way up to the central bank pulling the macroeconomic strings. But I want to leave you with one final thought to reflect on. Think back to those strict limits on credit creation. How do your own daily banking habits actually influence the national economy's money supply? Is your habit of hoarding physical cash in a jar at home actually slowing down the entire economic engine? It's definitely something to think about the next time you reach for paper bills instead of just swiping your bank card. Thanks so much for joining me on this explainer. Keep asking those great questions, and I'll catch you on the next one.